Have you ever been in a trade where the market is respecting a particular zone and you marked out that region, set your entry point on it with a target upward, but when the market played out, it took you out and continued going down? This particular loss you took on this trade is because you don't understand the concept of liquidity. So what I'm going to do in this video is to do a deep dive video into the concept of liquidity, where I'm going to talk about what is liquidity and how you can identify different types of liquidity. I'm also going to explain the concept of range and how to know the exact ranges to mark in a particular chart to give you the best entry points when you're taking trades. And then I'm going to talk about inducement and liquidity sweep. All of these things will be covered in this video, so you need to watch it to the very end to understand this concept very well. This is the second video in our technical analysis series. If you want to check out the first video I made, you can use the link in the description to check out that video. And if you're not subscribed to this channel, make sure to hit that subscribe button right now. We need to get to 100,000 subscribers before this year ends. Help us to click on that button right away to be part of our journey. Now let's get started. What is liquidity? These are zones on the chart where a large number of orders like stop loss or pending trades are typically clustered. A simple illustration of what liquidity means is, let's say I created a supermarket in an area where they have just 5 persons living there. What simply happens is there are not a lot of persons that come to buy things from our supermarket, right? For me to actually get more customers and make money, I need to relocate my supermarket to another area where they have thousands of people living in that area. The moment I do that, I'm basically going to the places where there is a lot of money and there are a lot of persons that will patronize me. And that is the basic analogy of what liquidity is all about. So the market is basically looking out for where there is a lot of money, so it can go there and pick that a lot of money before going back to the second area where it finds a lot of money. Now let's go back to the most important part of this video, which is the liquidity concept. To identify liquidity, if you look at this right here, market went up and came down. Now this area here is our area of liquidity, the swing high and the swing low right here. So this here is an area of liquidity and this area here is our area of liquidity. Now there are certain times when the market goes up, retrace, comes back to this area, go up again. Now people are going to mark this area. What did you see here? We have, here was the bottom and here is another bottom. People are basically going to mark this region here with the expectation that market is going to come back and test this particular region and then continue going upwards. But what usually happens is the market comes down, take out the liquidity here before going upwards. This is why you usually get trapped whenever you're in a trade, because people see one first bottom, second bottom, and they're like, this is triple bottom and the market is supposed to actually react from here and start going up. They set their buy entry here, but the market takes them out before going to that particular direction they actually want. Let me show you how a bearish one looks like. So market goes up, comes down, come back to this area here to respect this region, come down again, and people are expecting that it's supposed to react to this region and continue going down. But what happens? The market goes higher and sweep this particular region entirely, taking out all of the liquidity in this region before it continues going downward. This here is basically the simple analogy of what liquidity is all about. Now there are different types of liquidity: swing highs and swing low liquidity, which is basically the one where you have your swing high and your swing low. Where is your swing high here? Swing high and swing low is basically the highest point and the lowest point where the market is actually standing. So this here is your swing high and this area downward is your swing low. So this is basically the first category of liquidity. The second kind of liquidity is your equal highs and equal lows. And I've basically explained that with when the market comes and then possibly does a double top or something, and then people expect that market is supposed to respect this area at the third time and continue going up downward. But what actually happens is the market goes higher, sweep out all of this and then continue going downward. So this is the second category, which is your equal highs or equal lows. Whenever you find something like that, know that at some point liquidity in that area is going to be swept out. The third type of liquidity is trendline liquidity. So this is basically a scenario where you have the market is respecting a particular trend line. So this here is your trend line, right? Now what usually happens is the next time market comes back, people are expecting that they should have an entry point here and target higher prices. But what actually happens is market sweeps out this in this particular trend line and continue going upward. Another scenario is the market comes back and people that usually trade trend line enter their entry here, but what market does, it breaks below it, and the people that usually trade breakout and retest will possibly think that, okay, this market is bearish now because it has broken below this particular trend line, and most likely we should have something like this where the market react here and possibly start going down. But what actually happens is market hits here and does some little bit of retracement, but boom, market starts going upward. That way it took out the people that usually trade the trend line strategy, and also took out the people that basically trade breakout and retest and continued in the upward direction where it's supposed to go. So these are the three different categories of trend lines we are going to talk about in this video. So let's go back to real chart now and let's give some examples. When you look at this is ARC USDT and this is the 4-hour time frame. So first, let's mark out our swing highs and swing low, which you can basically call your range, and if you want to look at it as a liquidity, it's still very fine. For some of the persons that trade double top and double bottom, they can simply go here and put in a long position and target stop loss just below it and target upward. Now what will basically happen is this market is going to retrace, take them out completely, and continue going upward. And that's what played out beautifully. You can see it took them out and continue going upward. And for those that would have actually traded double top, they would have put their entry points at the top here because this was the last highs. And what happens, you can see it has taken them out, and you can basically see the market reacting downward. So this area here, these swing highs and swing lows, what basically happens with liquidity is when markets gets to them, it reacts instantly and start going to the opposite direction. Although there are certain times when it gets to them and continues in that particular direction, but many of the times it touches that area and then starts going upwards. And sometimes when it's the swing highs, it breaks above it and then starts coming down instantly. Now for those that trade trend line, they would have basically seen this trend line and like, okay, this market would most likely come back and bounce in this region and continue upwards. And they are going to go ahead to set their entry point here with their stop loss slightly below it and targets upward price movement, because this is confirmed to be in a bullish market, right? Now let's see what actually plays out here. It did not expect it at all. It took it out completely. So another example is this right here where we have this double bottom pattern, right? And then you're expecting that the next time price goes up and comes back again to this region, it should be able to hold there and form a triple bottom and continue going upward. And what most persons are going to basically do is to place their entry right here and target, put slightly below it and then target upper prices. Now what's going to happen? Boom, it takes them out. The triple bottom pattern they were expecting didn't actually hold, and then it broke below it, and at some point it's either going to continue going downward or just keep going upward. Another example is this pattern here where we have this triple top pattern here. You can see this is for a bearish scenario, right? So your market went here, retraced, came back to this area, retraced, and then came back down to this area. Now usually you should be looking at to set your entry point somewhere right here, right? Somewhere here, this region, and target possibly this lower point and target lower prices. Now what's going to happen is market to come, take out the entire area for liquidity and continue going downward. So it has basically used this area you're expecting it to react from as liquidity, and it has continued the direction it wants to basically go. Another thing I need to understand is this liquidity at the top here is called buy side liquidity. So it's usually the one at the top, and any liquidity you can find at the lower part or this bottom part here could be called a sell side liquidity. You can basically put it at the bottom and then it stays there. So anything here is the buy side and the anything here is the sell side liquidity. You need to note that whenever you're trading. And to refresh your memory, I've done the trend line liquidity where you basically draw your trend line thinking market is going to react from it, but it doesn't hold and it continues going in either of the direction it actually wants to go. But basically it takes you out from that particular trend line and it continue going to the direction it wants to go. So what I need to understand is when you look at the chart, almost everywhere in the chart, there are different types of liquidity. It could be the swing high and swing low liquidity, where you can also call it a buy side and sell side liquidity, or you call it an external liquidity. But the trend line you can see right here is known as an internal liquidity. Now, even in this area here, even in this chart here, you can possibly see double bottom and double top. This area could also be referred to as your internal liquidity. So any liquidity inside this particular range is known as your internal liquidity, but anyone outside this range is known as your external liquidity. Let's go to the second concept in this video, which is range. For you to identify a range, you simply mark out the swing low and the swing high in this chart. Now, why is this the swing high and why is this the swing low? This is because this is the highest point this market went to, and this was the lowest point it went to before it started going up or down. All right, so we mark this region out, and this is our range. Now, some persons like to use rectangle to represent their own. Anyone that basically works for you is fine. But what I need to understand is everything within this section here is a range. Now, what you can see right now is we just broke out of this particular range. How did it happen? This used to be the highest point, but over here we created a new highs right here. So automatically this becomes our new highs. And where's our new lows? Our new lows is basically this one right there. This is the last leg of price that led to this particular break of structure. So what you're going to do is to mark this place out. So this one is no longer the range we are looking out for. So this is our new range, and you are going to work with this range. So everything in this range is basically what we are going to trade. So we just broke above this new range. So this now is our new range. From this area up to this area here is our new range. So we are basically trading what is within this particular section. Now we have a concept called premium and discount, which I'm going to talk about later on in another video. But what I need you to understand is when you look at the range, you want to enter a buy from this area here and target the higher side, and you want to sell or short from this area here and target the lower side. So you're trading within this particular range. There are two different types of ranges. The first is external ranges, and the second is internal ranges. Now, an external range is this particular range you can see right here. So you're basically concentrated on when the market breaks within any of this particular region here. But every other range inside this region here is your internal range. Now, this is a 4-hour time frame, and if I switch this to, let's say, 1 hour, you would see what's going on here beautifully. And if I even switch to 15 minutes, you're going to see that there's a lot of things that are playing out inside this particular region. So any range you're drawing within this particular region, because even in this region here, you can simply say this is your swing and this is your swing low. But in real sense, this is just your internal range. Basically, your overall range, which is the external range, is this one right here and this one down here. And your basic concern most times should be on the external ranges and not on internal ranges. Although you can trade the internal ranges and make some money for yourself. I'm basically going to show you how you can do that later on in this video. So let's go on with drawing this particular range. And right here, we just broke out from this level here, giving us a new break of structure. So you can mark it as your BOS. And where is your new range? Our new range is basically between this region here, which is your swing high. Now, where's the leg of price that led to this break of structure? This here is the leg of price. So you mark this area here and this area here. So this is your new range. You're actually working with this particular range. So next, it is down to this area here. Some persons would want to take their buy entry here and target an upwards price movement. Having something like this, your stop loss below this range and target higher. Well, this is not what I want to talk about now. Okay, so this right here is your new range. You can switch to smaller time frames. You can even do this on 15 minutes and use smaller time frame to determine your internal ranges, which you can still find when you look right here. And now we just broke below this. So here's our new range. Our new range is between this area and this area here. So I'm just going to mark this out. So this is our new range we are interested in. You can take this one out since that is not your focus. And basically, anything that plays out within this region. So we actually do have a new range now. Where's our new range? Our new range is basically from this area here, which was the lowest point, to this highest point here. So this is basically how to find a range on a particular chart. So let's go to the next part of this video, which is inducement. What is inducement? Inducement are specific zones in the market where liquidity are intentionally created to tempt traders into taking forced entries, often resulting in stop-loss hits before the actual market moves to the place it wants to go. Inducement is basically when the market is in an uptrend and instead of the market to retrace very well, it comes down and put in something like this and put in a new high, tempting traders to think that this is the new leg of price. Now, if you remember ranges, you understand what the new leg of price is. And some persons are going to mark this area here as their swing low and this over here. And some can go to marking their supply and demand region. I'm going to talk about that later on in another video. And possibly go ahead to enter a long position here. But what usually happens is market comes here, does as if it wants to respect this area and just continue coming backward to this area here, which is the original demand region, before markets continue going upward. A better representation is something I have here where market goes up, comes down to possibly the buy region, and then goes up again, and instead of retracing to the buy region, it's created a new highs, making people to think that market has created a new leg of price, and if it comes down, it's going to respect it. But what happens is it comes down, sweep below every one of these thing here and taps this buy region and starts going upward instantly. Now, this is the basic concept of inducement. Now, it's very, very difficult for you to spot, especially if you're a newbie or like even sometimes you get trapped by it. But I'm going to explain that on the chart right away. Let me give you an example of inducement. So if you look at this right here, we started putting in higher highs and higher lows, and then we'll put in a new highs here and a lower high, a higher low here. And some persons are just going to mark out this region here, thinking that the market is going to come back to this area here, and they're going to take a long position and target higher prices. But what would the market do? Market will come back, take them out entirely, and continue going upward. Now, this year, they were basically induced to think that this is the swing low for this market to go up, whereas there are key areas there where you are focused on. If you look to the right, before this inducement occurred, you can see there are some fair value gap here. There's one fair value gap here. There's another fair value gap here. This year was the last fair value gap. What did you notice here? The market came, tapped into this fair value gap and continued going upward. So obviously they've been induced to think that this was the right area for them to actually take a long position going up, but you swept them out, inducing them, tricking them to think this is the area, and took them out and then continue going upward. I'm going to give you another example with this right here. You can see we are clearly in an uptrend, right? Now, some persons are going to be cautious of this area here as swing low, just because we are in an uptrend, and this area here as swing high. What actually happened, for those that would have entered the trade here at this region thinking that we won't go below this area since it's an uptrend, what actually happened? They got kicked out and the market even went lower before it continued going upward. So what actually happened there is, whenever you want to determine where is the right area for you to enter so that you don't get tricked by inducement, you simply draw out your swing highs and your swing low. So this was our swing low over here, and I'm going to take this one out, which is the inducement, but I'm going to mark it as dollar symbol, which usually for inducement, for liquidity to be taken out. And then here we have our swing highs before this occurred. So let me take this one out so you understand it. So what we're going to basically do is to draw your Fibonacci retracement from your swing low to your swing high. And what did you notice over here? What you can see here is, if you're looking to take a long position in this kind of situation where the market is coming back, right, and then you're scared that this is your inducement, you would basically, with this Fibonacci retracement, you would have seen that this area was perfectly sitting at 0.6 region and upward. So you want to focus on anything below the 0.6 region, possibly targeting 0.7 region. Anything between 0.3 to 0.618 region is basically not the best entry point for you and could get you induced. So you can see that the moment the market started coming back to this region, this area which serves as your inducement based on Fibonacci retracement, it swept below it and came perfectly to the 0.7 region before it continued going upward. And for some other persons, they can even, if I take out this Fibonacci retracement, what you can notice at this area is we also have, over to this side here, is our buy zone. And then this area here is our sell zone. So you basically want to take trades in your buy zone But using a Fibonacci retracement can make it very easy for you to know when it's possibly the best area to look at to enter trades and not the best area. So you're not entering. If I put this again from the swing high to swing low, this area is 0.3 to 0.618 region are not the best areas to enter trade. They are basically there to serve as inducement a lot of the times. So your best bet is possibly within the 0.7 region or possibly below the 0.618 region, and anything within this area, it's a basic and it's a good entry to get in and then target higher. In a situation where this was a downtrend, you're going to basically draw it from the top to the bottom. I drew this from the bottom to the top previously. So if you look at the top to the bottom, where is your 0.618? You can see it's within this area to this area here. So you want to enter trade at this 0.78 region or even higher, and then target lower prices. So that is basically what you want to do if you don't want to fall for inducement. But let me know if you want me to make another video about inducement. I would make another video about it. Now let's go over to the final part of this video, which is liquidity sweep. Okay, the concept of liquidity sweep. If you're following this video from the very beginning, I've actually talked about liquidity sweep, but I just want to talk about it personally, so you should be able to understand it. If you look at this chart right here, we have two double top, right? Now we have two double top. Now most sellers would want to sell from this region because it has actually obviously expected it every time it came down, right? But what actually happened the next time it came back to this region is it sweeps above it before it continued going downward. So sometimes identifying some of these key liquidity regions where possibly swing highs and swing lows, or where we have double top and double bottom, or triple top or triple bottom pattern and all of that, could be very helpful for you to know that at some point market would most likely sweep that area of liquidity. And once it's done sweeping, that is when it's going to continue going in that direction it's supposed to go. Another scenario is, if you look right here, we had something close to the triple bottom style, right? So it came down here, went up, came down again, went up, came down, touched the same region, went up, and finally it broke below it and even went way lower before it started putting in upper prices. So identifying this region is very important. Let me also show you the third one, which is the trend line liquidity. If you look right here, this is a good example of trend line liquidity. So market went up, came down, came back again to this trend line, and retraced, came back again and swept above it. So every time we have a trend line, it is obviously going to break. Now the only problem is you can't tell how many points it's going to touch that trend line before it does break it. But one thing is certain is it's going to obviously break that trend line and continue going in that particular direction. So whenever I see a trend line, it is not the best entry point for you to enter a short or a long position. Rather, it's for you to know that at some point the market is obviously going to sweep that trend line and continue going to each direction. So when you have these three things in mind, it's going to be very helpful when you want to determine the areas to actually look out for liquidity sweep and the rest of that. So this is all of it about this video. I really hope it did justice to this concept. If you enjoyed it, make sure to give it a like and subscribe to this channel. Also have in mind that this is a series where we are doing videos about technical analysis, and this is the second part in this series. We have other videos coming very soon, so make sure to subscribe to this channel if you've not done that. It is very important because we want to get to 100,000 subscribers by the end of this year. And also, you can check out our previous videos about technical analysis. All links are going to be in the description. And for further videos, you can also check out our page later on. They are going to be posted on our page as the videos get produced. If you want to watch the first video I did about technical analysis, where I talked about market structure, then click here to watch now. Thank you so much for watching this video, and I'm going to see you in my next video. Bye for now.